We have Aditya Shah, who's the founder of Hercules Advisors, joining us, and we also have Mahantesh Sabarad joining us for the review. Gentlemen, welcome to ET Now.
Good
Right.
evening.
Mahantesh, I'll come to you first. How do you assess the results of the bank? Given that it has a high base, it is one of the largest banks in the country. How will the growth pan going forward?
So the results are good. On the backdrop of the results that they've announced, you would notice now that the merger is over. The growth is steadily happening. But from a purely market share perspective, I think HDFC Bank is losing momentum. And post the merger, there are quite a few ratios which are still worrying for the bank to take care of. One of the ratios is cost to income ratio. It's now in the 40s. They need to address it and bring it down. There is another ratio that is now troubling them. Basically, the deposit growth rate is pretty slow, and the CASA ratio is just about 38 odd percent, little less than 38%. That these are concern areas for the banks to address. So, from a growth perspective ahead or outlook perspective ahead, unless the bank addresses these kind of issues, it's going to be a little difficult from the investors' perspective to really take any, allow any premium to the bank that it used to get in the past.
Right, coming to you, Aditya, a couple of point of concerns that Mahantesh mentioned for the investors then before they give a premium to the bank. But what, according to you, is the pain point or the areas of concern after the results have come out and we've gone through the results? How are you reading into the numbers, and what do you think will cause a worry for the investors?
So, a major and primary concern why the HDFC Bank stock has undergone a derating is because the NIM, the net interest margin, the HDFC Bank's book had an NIM of above 4%. HDFC Limited's book had an NIM of below 3%, and net now the integrated book has reported an NIM of 3.4%, and because of that low NIM, the net interest income has not increased as per expectation. The whole concern around the merger was that the NIMs will erode in the long term below 4%, and that is what has happened over the last 2 quarters, while the management has guided that they will get the NIMs steadily improved to 4%. Right now, at this stage, the biggest pain point on the results are fairly okay. There's nothing to complain about per se. I don't think that there's a problem with the deposit growth as well. In fact, the HDFC Bank is outperforming the entire banking sector on the deposit side of it. The major concern is if the NIMs does not improve, so the profitability for the bank inherently then goes down, and the ROEs start to get hit per se. So we need to ask from the management and understand from the management how the NIMs will move from here on. They have come down from 4% to about 3.4% this quarter, and going forward, how will the trajectories of NIMs be? The trajectory of NIMs would be that they would come back to 4%. Then the market will not have any problem per se, and the market will be okay with the stock. If the NIM does not come back, then there is a concern, and that is why the derating on the stock has really happened. So overall, decent set of results, nothing to complain about per se, but the NIM is a big number where for at least 4 quarters, the HDFC Bank has continued to struggle,
Right.
and
So,
we need to watch out what happens.
So Aditya, my next question was on the NIMs only. How do you think the NIM's trajectory will pan out going forward? And what kind of an uptick are you penciling in as far as the cost of deposits is concerned for the bank?
So HDFC Bank is aggressively investing in its branches, and that's why we're seeing that the cost-to-income ratio has now traded above 42%. It will continue to invest aggressively in the branches over the next 2 to 3 years, as the management is already guided. HDFC Bank is not paying the highest interest rate on the deposits. However, the cost of funds for the entire system is moving up, and that's why there's a problem. The problem, especially for HDFC Bank, is that because secured credit is coming from the HDFC Limited book, that comes with a lower margin per se, and they need to expand their unsecured retail credit Once they start to expand their unsecured retail credit, which comes at a higher margin, the NIMs will start to recover over a medium-term perspective. But one thing is for sure, the NIMs will take time from the perspective that the book balance is right now skewed towards the secured retail side. So it will take time, but surely the management has guided that they will recover. We need to talk to the management and see what happens.
Coming to you, Mahantesh, how should one read into the credit costs? We saw the credit costs, they have come down for this quarter. Do you expect the bank to maintain its credit quality going forward?
So the credit cost is a function of what Aditya was also trying to refer to in terms of the balance between the secured book and the unsecured book. Not only that, it is also related to the kind of quality of the unsecured credit itself that they are getting into. So improvement in credit cost is a welcome, measurement, the quality measurement that has come out from these results. But now that the NPL levels are very low, somewhere in the range of just 0.3%, it's going to be very difficult for the bank now to offer any improvement on the asset quality side per se. The lever that needs to be touched for them is grow fast on the top line, which means advances growth needs to be much stronger. Advances growth will happen if you have better deposit growth coming in, and your overall margin expansion is linked to, and this is at the PPOP level, is linked to the way you control your costs.
Right, Mahantesh. We get your point. But on that note, we'll have to let you go, gentlemen. Aditya, Mahantesh, thank you so much for joining in. We will be speaking to you later on. But for now, thank you so much for joining in.